coefficients, the impact, the correlation between the future return and the ESG return is not stable, but the measurement error should be in theory. And what we see here, this is the noise to signal ratio that we calculated. It is extremely stable. There's almost no change here. So this is actually gives us hope that the results we find are actually the very close to what's really going on in the data. This, for me, this makes the paper actually very strong. This result over those 8 different months estimated. And so we also give the noise to signal ratios. The noise to signal ratio is actually on average 61.52%. So 61.52% of ESG rating is noise here. And we also give the average for different raters. And as I said, for example, TVL, as it is updated daily and it's web scraped mostly with machine learning, it should have a very high noise to signal ratio. And it does. Other companies like ISS, who do like a really more profound analysis of the company and really approach the company, actually have a much lower noise to signal ratio. So the unique methodology is actually reflected in our data, in our findings. We also see that between different regions, there are slightly differences. Europe has a higher noise to signal ratio than, for example, the US or Japan or Great Britain. And yeah, so this is actually what we find. That means, and this noise to signal ratio here implies that the coefficients controlling for noise go up by a factor of 2.6. So controlling for noise means that, or it means that actually the true link between ESG performance and future performance is 2.6 higher than previously estimated. So there's one big problem here in all this study. It is that we have very short time series. We only have 8 years. And so that means in our setting, we cannot use firm fixed effects, which basically means that we might have an omitted variable bias in our analysis. This omitted variable bias could be, for example, that ESG ratings or ESG performance is very much correlated with management quality. And it's actually what we find is just about management quality, but not ESG. It could also be that it just inflows, because there's nothing more explosive at the moment than sustainable investing in finance. So that could be a driver of returns. And we actually, in the next paper, I will show you that might be the case. But what the great thing is about this paper, no matter what actually correlates with it, we still see that we actually isolate this omitted variable bias, and hence we can actually determine this noise to signal ratio. So the noise to signal ratio is true. What is not necessarily, what might be actually biased is this coefficient here. So it might be actually that if it doesn't correlate with management quality or with flows, it might be actually a negative return or a negative correlation. And so this is actually, yeah. So this paper is really just about, and that's important to say, it is a first step towards a real identification of a causal relationship between ESG performance and stock return. It is not, we cannot go that step fully because the time series are unfortunately too short at the moment, because the whole sustainable field just started, unfortunately, just very recently. Yeah.
Florian, so do we understand anything? So let's say our students wants to take one of these ratings and they don't want to do, all these analysis. It's just going to be an input into another analysis. And do you have anything to say based on these results? Which one is going to be sort of more reliable, or nothing?
No, unfortunately, I cannot. What I can say is that it actually would be great if you had at least 2 ratings or 3 ratings. And there are ways of even different information, right? three ratings actually. Yeah, one rating is complicated because with two ratings you could already use actually our procedure, because you could use the second rating as an instrumental variable, and that would actually improve the results by a lot, as we see actually in our paper, and we show that actually in simulations in the last section of our paper. Yeah, but you cannot really pick one rating. It really depends on your setting. It really depends on the region, and it really depends on what your left-hand side variable is. Because this is actually a framework you don't necessarily have to use stock returns. You can also use accounting variables. You can all sorts of things, whatever you wanna look at using ESG ratings. Okay, so we have measurement error in the ESG ratings. And it's surprising, actually. There's one database where we find that actually where it's really obvious that there's measurement error going on, and that is Refinitiv. So we actually, for a project, we downloaded the same data twice from Refinitiv ESG database, which is one of the biggest raters, and we found that they don't correlate 100%, which for us was odd, because if you download data from about Danone and Volkswagen in 2011, it should be the same. It should have the same ESG rating, right? Just because you did the download last week and this week, shouldn't be no difference. Yet there is. And you can see here on this graph, we downloaded the data 3 times. So the first one is actually in 2018. The second one is in September 2020. And the third one is in November 2020. So only 2 months apart. And what you can see, the same company has completely different ESG ratings, even in 2011. And what you also see, it's not a rescaling effect, because the slopes of those, the slopes actually change, the variability changes, right, over time. So we actually were really puzzled, and we just didn't know what was going on. So we started investigating, and we realized that if you just download the same data again with a difference of 6 weeks, 80% of the ESG scores out of 7,000 would change in 2012. So almost every score changes just in a matter of weeks. And this has been going on for years and years. So the first thing then we obviously thought, maybe they're trafficking the database to make it look better, because those databases are used in the academic studies, that the same that we did, or for example, for backtests in portfolios, right? So asset managers run backtests of a new ESG strategy to show that if they had started that strategy 10 years ago, it would create overperformance. And this is how they market their new funds that just started, right? And here we see actually that the newer the download, the higher the impact on the return. And that for me is crazy. So if you look at the 2018 download, and here again, the backtest or the asset, the regression of stock return in ESG goes from 2011 to 2017. And so we download the data in 2018, and you have a coefficient that is not significant. But when you download it in 2020, again, the same data, it is significant, and the coefficient is much higher. And if you then wait again 5-6 months, it even goes up more. And if you then wait again, it most likely goes up again. So the nearer the download, the higher the correlation with stock return. That is obviously problematic. So we did a deep dive into the data. And as I said, with the UN Global Compact, it's very unambiguous, right? There's a database, you can look it up. And one of the indicators in the ESG database of Refinitiv is the signature of UN Global Compact. And we realized that over the span of those 4 years that we have in our sample, so we started in 2018, and the last analysis we did was in 2022. They revised 250 times the signature of the UN Global Compact out of 7,000 companies. That's quite a lot. And even what they just a year ago, they flagged actually for the whole time up to 2011, back to 2011, that Volkswagen signed the UN Global Compact. Volkswagen was one of the biggest corporations in the world. So how can you miss that? I don't know, but I'm still investigating more and more. So we also did that for other ESG raters, and we only found this, these rewritings with the Bloomberg disclosure scores. So what I want to say is, if you actually, if you write a master thesis, or if you want to write a research paper, then you have to be very careful with the Refinitiv data and the Bloomberg data, because the analysis will be most likely flawed and have a look ahead bias.
Excuse me, have you reached out to Refinitiv?
Oh yeah. I reached out. They didn't answer. Unfortunately, it was really sad. And then a journalist wrote about our paper, and they declined to comment about the controversial part. So literally, that's what it said. Declined. And then actually now the paper had actually quite a big impact, because some regulators in the US reached out, and now also the ESMA and the FISMA reached out, and they said that they most likely come up with a rule in November, because of this paper, that ESG raters should not retroactively rewrite their data. So yeah, it had quite a big impact actually. And in this case, I think it's an important paper, because those practices have to be highlighted and they have to be changed. It's still a young field, right? But still, it doesn't make it, I don't know if that makes it better, but yeah, you shouldn't do that. It's somewhat false marketing.
Another clarification, when so you mentioned that they changed the methodology. So when do they do that? Do they back sort of feel the things? So that is kind of a justifiable, quote unquote, rewriting. Is that correct?
Yeah, exactly. So there are two things going on. There's those two methodology changes that I talked about, and that changes every ESG score. So no ESG score then, even in 2011, when there was one change in 2020, and all the scores changed completely. We show that in the paper. But the more important and the more odd part is actually that they also, that even though there's no methodology change between today and next week, you still have different scores. Here, for example, this was after the methodology change, and there was no methodology change between February 9th and March 23rd in 2021. So that's only 6 weeks, right? And in 2011, 80% of the ESG scores changed. And 4% of the companies had a change in raw data items. What do you figure out actually in what can you additionally figure out about a company in 2011, right, that you haven't known in 2015? I don't know, right? So that, for me, that is a big problem. Yeah, that is a really big problem. Yeah, so this is actually also a measurement problem, something we wouldn't have really thought about, because I actually, before, I thought the real measurement error comes from this, our measurement methodologies, but also just the way I run databases might affect the measurement error of ESG ratings. Okay, so last paper. That is actually fairly recent. I've just put it online 3 or 4 weeks ago. And this is about the economic impact of ESG ratings. And here, what we wanted to see is actually if MSCI or if ESG rating changes, we wanted to actually causally find a way of relating rating changes to returns and also to fund holdings. And so the way we did it, we looked at MSCI ESG rating changes, and they don't change every year. They change fairly every 3-4 months for each company, and it's very random, the dates. So there's no what we call event day clustering. They don't change at like a given schedule. And so we want to see this impact of MSCI ESG rating changes on mutual fund holdings of ESG funds. So the question is, do actually ESG ratings influence those ESG funds? No, I haven't seen any actually yeah, I hadn't seen, or there's no research that has actually shown that previously. And what we see here is actually the big answer is yes. We see actually that when a rating changes here, this is the gray line, then if it's an upgrade for MSCI, then the holdings in a fund will be increased, and for this given firm. And if the MSCI downgrades a company, then the holdings in this in the ESG funds will be downgraded, will be decreased. And the interesting thing is that, so this is important for a causal interpretation, we see that there's no pre-trend. So we don't see anything that hasn't started before. So that makes us actually quite confident that this was actually the changes in the mutual funds comes from the rating changes. Those clouds are actually, so those bands are confidence intervals. So that means this is statistically significant. So we did the same with returns. And here we have the same pattern. Upgrades increase return and downgrades decrease return. But what's so interesting about this is actually that it takes so long. Here, it takes up to 2 years for, or 18 months, between 18 months and 2 years for ESG funds to really integrate the new information of ESG ratings. For me, that's puzzling, because if you think there's an overperformance, it's a source of overperformance, you would really hurry up because you want to catch the overperformance before anyone else does, right? But you don't see that. So for me, the way I interpret it is that it's actually basically preferences that drive the changes in the holdings. That means that fund holders actually they have a preference for ESG, but they don't necessarily have a view that this will create overperformance. Even though you hear a lot of talk about overperformance, so this is a little bit like stated preferences versus revealed preferences. And the interesting part is that you also see that with the return, the same patterns. So here I cannot really link them causally, but it seems it's very likely that actually the fund holdings that change, that pressure then the returns. So it's actually the fact that the mutual funds buy those stock that actually will drive then the return. And so that means also that the return that we found so far might be flow driven, at least partially. So it might be just driven by a shift of preferences. This has a lot of implications, because if it's a shift in preferences, that means also that we should expect lower returns in the future, according to financial theory. And I invite you to read the paper. There's a lot more robustness checks and a lot more analysis around that. But this is just basically the main message and the highlight of this paper. So this is the last slide. Let me talk about the implications. ESG ratings are complex constructs, as you see. They're not complicated, they're just really complex. And you can't really reduce the complexity. Because that's, you hear that a lot, right? There's a lot of talks about, for example, standardization. But I'm very much against standardization, and I talked a lot with regulators, also with l'Autorité des marchés financiers in Paris, that you should not standardize ESG ratings, because there are two things that could happen when you actually standardize them. But there are two reasons why you shouldn't standardize them. First is expression of preferences, right? And everyone is entitled to their own preferences. How can the regulator tell you that climate risk is more important than diversity, for example? That is your call to make, or the ESG rater's call to make, right? The other reason is that there's a substantial amount of measurement error. And if you now standardize something that you don't know how to measure perfectly, then companies will learn after a while how to game the system, right? So that would be a negative side effect. The other reason would be also that there's ESG ratings. I forgot one to say. Sorry. So the first one was, oh yeah, we would standardize, since we standardize then a faulty way of measuring, for example, CO2 emissions, we would prevent any ESG rater to innovate, because there's no reason to innovate. They would still, because they would have to sell the standardized rating, right? And the only way we can get out of this mess, or we can improve those ESG ratings, is by continuously innovating. And so when I talk to those regulators, my view is that you should create more transparency. You should force ESG raters to open up their books more, so that they can be criticized, and they then also have to compete on how good their measurement methodologies are. Because if it's a black box, you can't really criticize them. So so that's why I'm for more transparency here. And as a summary, I can say I think all this research shows that ESG ratings do contain a signal. And so that doesn't mean that doesn't make them insignificant, because there's a lot of talk is like, they have measurement error, they have those problems. Do they matter? And the short answer is they do, actually. Just because they are not perfectly measured doesn't mean that they're not useful. Thank you. And now I'm open for questions.
Thank you very much for this great presentation. I learned a lot. I hope, and I'm sure students did as well. So, guys, if you have any question, please, you can just unmute yourself and ask. We have 4 or 5 minutes.
Yes, I have a question. Do you hear me?
Yes.
Yeah, I can hear perfectly.
Yeah, okay. First, I would like to thank you, because I didn't realize at first, but I used your work last year on my master thesis on the correlation of ESG rating. And my question is the following. So you spoke about how exciting is ESG investment, how it changed economy, but is it really changing the ESG itself? Like we saw some misconduct of ESG rating agency on, for example, OPEA, and we see that there is now a competition between rating agencies, to give the best rating to the company that they have to rate. So this competition make them kind of obligated to be kind with their clients. So there is a client to like relation.
So here they don't necessarily have to be kind with the client. Would be here the investor, right? So this is a little bit different than credit risk ratings, where the client is actually the company, and then there is actually something that would be rating shopping, where actually firms or companies reach out to the credit risk rater, where they can actually get the best rating. Here with ESG ratings, this is a little bit less the case. So because actually the investor pays for the ESG rating. But there are other ways of where there are conflict of interests happening, and that would be, for example, some raters they actually they give advice, so they do consulting how you could actually improve your rating, and then obviously you might actually end up giving them a better rating, because if they give you money for telling them how to improve, then that wouldn't be reflected, and the effort wouldn't be reflected in the rating. Obviously, the firm would maybe not come to them again anymore. So those conflict of interest exist, and regulators actually are on it. The ESMA is on it. The European Commission is on it, and since yesterday, the Senate in the US is on it too. They send out a letter to 12 different raters with actually very detailed questions about those conflict of interests and also other data problems. And the SEC is on it too. So it seems like, everyone is talking about it. And I think there is some, I think there's, as I said, it's a new field, and we still have to learn a lot about the field, right? But I think there is now a certain momentum.
Okay, thank you.
Thank you. Others? I'm sure you have a lot of questions in your head. So Florian, do you have any expectation if there is no regulation or anything? Do you have do you have any expectation that the rating agencies, the raters, the rates are going to converge, or should we actually hope? You said that we should not hope for convergence because that's how it's going to be, right? So they have different sort of the ways that they do that, but is there any hope for like reason to believe that they are going to converge or not?
So as I showed, right, the ratings basically have two parts. One part is an expression of preferences. So do I include an indicator or not, and what's the relative importance? And that obviously there's not necessarily a reason to diverge. Everyone has their own preferences, and that's also good, right? And that's okay. The measurement divergence then is a different problem. And here it might be if we actually getting closer to the true ESG performance at one point, that then there might be convergence. But I haven't seen that in the data so far. There's also, I mean, yeah, we're still in the beginning of the assessments, yeah, for sure.
And I mean, to some extent, if they are converging, why do we need so many of them? So there's going to be, you know, some of them, they have to go out, right?
Yeah, I think it will. And I mean, you already saw that the biggest financial companies all bought ESG raters. Like those 8 big ESG raters that we had in our sample, they were all little startups a couple of years ago, and they got bought by Standard & Poor's, Moody's, FactSet, Bloomberg, and all of those, right? And so, yeah, I think that that will actually make it more problematic for smaller companies now. And I think we in 10 years the market will probably look fairly similar to what it looks now, but the market now doesn't look at all similar to what happened actually 5 years ago. That is my prediction.
Do we have for one last question, or you're running out?
No, yeah, I'm fine. I have a question if it's okay.
I'm fine. We can even do 5 minutes more.
Can you hear me?
Yeah.
Yes.
Okay, cool. First of all, thank you for the presentation. It was very interesting. I have a very basic question. I feel like there is a misconception of ESG because a lot of people think that investing in ESG products will lead to like a greener or better world. But when I listened to your presentation, it was more about stock returns predictability. So do you think it's only about that and not about like changing the world, making the world greener?
That is a very great question. I really like that. So the problem here is that it has to go through returns at some point. But my research I haven't arrived at this point where actually really I'm able to look at what happens in the real world. We are preparing some research about that, but we haven't done it. The problem here is that, there's a difference between the impact on returns and then actually the impact of really on the real world, right? As you said. According to financial theory, if, for example, you as a preference, you buy a stock, right, because you like it, let's say Liverpool FC or Borussia Dortmund, they're listed on the stock market. You really like them, they're playing well at the moment, or they played last season, they played very well with Haaland. This season, they're not that good because Haaland plays in Manchester City. And so, but you like Dortmund so much that you keep actually that stock, right? So most likely you have then a negative return, right? A negative expected return because, yeah, you just hold it for a preference. But Dortmund actually has now the stock price is higher than it should be because there's so many people that hold it for preferences. And that is a little bit the same that happens with ESG stocks. So in order to actually give them companies better access to capital, we buy them because of our preferences, but then we should see in the future negative expected returns. We haven't observed that because we're always talking about positive returns. So if then we observe this negative returns, that would show us that those companies face a lower cost of capital, and the lower cost of capital, then they can, as I said, they have easy access to financing, and then they can do more of what they already did, so more good in the world. That would be a way of having impact. So far, no one has really ever shown that causally, that there is a real impact, and that is a big problem in the field, and that is something the whole field has to reckon with in the future for sure. This question about impact and the negative returns, because that is actually, that will change the narrative completely, because now the narrative is positive returns, impact, but in financial theory that's not compatible.
Okay, cool. Thank you very much. We are a few minutes over time. Thank you, Florian. We enjoyed a lot. We learned a lot, and we hope to again see you. We will see you, I think, within a month or so again at EDEC, I believe, or 2 months. I don't know. Sometime in future, we'll see you again, hopefully. And I wish you a great day.
Thank you. I wish you a great day to everyone, and thanks for listening.
Thank you very much. Bye.
Bye.